you're a physician looking to grow meaningful passive income, did you know that you can do that by investing in real estate without having to find properties, analyze complicated numbers, oversee construction, or deal with tenants? In 2020, after working 10 years as a radiologist, I realized that if I followed the traditional method of investing in the stock market, it would take me until my 60s to be able to retire. So I deep dove into real estate investing, and by the age of 41, I had 6 figures in passive income from my real estate portfolio that allowed me to cut down to a day a week in medicine to spend more time with my young family. I've since gone on to help over 15,000 other physicians learn about earning meaningful passive income through real estate investing. And here's the best part: even when you invest in real estate syndications passively, without getting involved in the day-to-day work, you still get to benefit from 2 to 3 times higher returns, including tax-free cash flow day one. So if you're done with working harder, taking more call, and living frugally, and are ready to put your money to work for you, book a call with our team at gwcapital.com. We are constantly underwriting and doing due diligence on multiple deals in strong markets, doing all the heavy lifting for you. And we present some of these deals only to members we have connected with previously. So if you are ready to seize the opportunities present in this market and get off the sidelines, book a call with our team at gwcapital.com so we can learn more about your goals, walk you through the process, and get you priority insider access to our better deals.
I just wrapped up paying my taxes, 2024 taxes, because I usually file an extension, and mid-October is when we get our taxes done. And so I just finished paying my taxes. It's always a time of the year where it really, this is the time when you really get your taxes done, when you start thinking about the next year, right? And so for me, it was very eye-opening. It was a time that I really started strategizing around how am I planning for 2025. I wanted to take all of that momentum into tax planning. I love this quarter because this is where, it almost seems like we're getting sluggish, we're getting close to the holidays, but there's so much you can do between now and the end of the year to really move the needle. And so if you are a high income earner and you're looking at this quarter thinking, oh my God, I'm going to be paying multiple 6 figures in taxes again for 2025, and you don't have a plan, then this is your massive action plan, right? So you have 60 days to fix your 2025 tax story, and I want to give all of you 5 completely legal, super powerful moves that you as high earners can use to slash your taxes before December 31st. The last one, the 5th one, is something that everyone can use, everyone should be using. Especially if you're thinking Roth conversion, stay with me. I don't learn a lot that is new. Usually I'm refining concepts I already know, and this was completely a concept that blew my mind, so I want you to wait till point number 5. But full disclosure, this is completely educational. I am not a CPA, right? And I'm not your CPA, so please talk to your tax advisor before you use any of these strategies, and just make sure that it works for your situation, right? And all of this advice should be personal. But if you are a high income earner and you don't do anything for the next 60 days, then you are volunteering to overpay. I don't want you to do that, so let's get started.
Welcome to Generational Wealth MD's podcast on financial freedom through investing in real estate. My name is Param. I'm a mom, radiologist, real estate investor, and mentor to others looking to start or scale their real estate portfolios. The goal of this podcast is to provide you with inspiration, strategies, and insight so that you can stop trading your time for money and live life on your terms. If you love the episode, don't forget to subscribe and leave a review.
Okay, I'm going to start off with 5 powerful tax moves. Some of these may not be applicable to all of you. Number 5 is applicable to everyone, so I want you to wait till the end. I'm going to start off with the first one because I think it's one of the most powerful things, right? And I find that I always say 5 moves and then I have all these subheadings within it, so I end up giving you tons of value. But the best part is that you can pick and choose what makes sense for you, right? That's the most important thing. So power move number 1 is always going to be, how can I reduce taxes on my earned income, right? So according to the IRS, you have active income, right, which is tips, commissions, W-2, 1099 income, right, any earned income. Then you have passive income, which is your rental real estate or any business that you're passive in. And then you have portfolio income, which is where interest income, dividend income, and stocks, all of that the gains, all of that. So separate, 3 separate buckets, right? So let's talk about the one that's super powerful for most of us. It's going to be reducing taxes on your W-2 income, right? And so that's where we get hit the hardest, right? The more money we make, it's a progressive tax system. And I want to give you 3 levers. I think in the email we said 2, but obviously as I'm thinking about this and putting things together, I was like, okay, 3 super powerful strategies that you can use today, right? That you can plan on using before the end of the year. And I know the biggest question that comes up, and I've had conversations with so many people, and the first one, the thing is almost, well, is it too late in the year to do it? And I know that for all 3 of these strategies, you're still not really late, right? And we'll talk about what those timelines look like. So 3 powerful strategies that you can use to slash multiple 6 figures off your W-2 income before the end of the year, right? Who wants to hear this? Okay, so let's start off with the first one, right? The first one's going to be the short-term rental strategy. And many of you have heard me talk about this before. I just want to show you how powerful this is and how this can work even right now, right? So we had the Physician Freedom Summit. It was this month. It's hard to believe. It was this month, early this month. And, one of our investors, one of our community members was at the event, and it was a super powerful event. And I've just been amazing to see the transformations that came from the event. And if you haven't signed up, you can still get the recordings. It's generationalwealthmd.com/summit 2025. That's in lowercase and just one word, Summit 2025. But she came to the event and she decided she was going to buy a short-term rental, again, from a tax perspective, right? She wanted to really slash her tax liability before the end of the year. And so she went ahead and we connected her through our network to our agents who are, again, getting this done in a timely fashion requires you to have support, and we want you to buy profitable properties, not spend a lot of time doing it. And so she reached out to our agents, and she just sent me a text today, 300,000 tax loss, right, from this one property. So powerful moves in the last quarter. And so it was just like 10 days before she decided to connect with the agent and to when she's locked on a property, and she knows that the cost segregation study is going to give her this. This is what her estimate is going to be, right? So super powerful tax move right there. You do need to meet certain criteria. You need to hit material participation, which means you need to spend 100 hours on that property before the end of the year. Now, most people will say, can I do it? Can I still spend 100 hours on the property? How easy is it? You can combine the hours with your spouse. So yes, between the two of you, if you put 50 hours each, then you can still do this before the end of the year. And it just sounds like a lot, but year after year, like in October, we have 10 other students within the community right now who are closing on their properties, right? And they're doing the same thing. And so yes, it can absolutely be done before the end of the year. Typically I tell people, if you're getting a loan if you're getting a 10% down second home loan, and so yes, you can do this with a 10% down second home loan, you have till November 21st. So you have another 3 weeks to really execute the strategy. And like I said, sometimes all it takes is a week to 10 days for you to really be able to go in and buy your property, right? So you still have till the 21st of November if you're using a loan. If you're buying all cash, you have a little longer. You have 6 to 8 weeks to go ahead and execute the strategy. And so you need to hit material participation. Yes, that can be done at this time. You can combine hours with your spouse. 100 hours is what you need to do to hit material participation. And then you need to have 1 to 2 bookings before the end of the year, which is why we want you to time this, right? And so when I say this, I want to also say you should not let the tax tail wag the dog. So end of the day, you want to buy profitable properties, right? And we also want you to not spin your wheels doing this. And so you want to have systems, support, our agents. If you work, this is exactly why we built our coaching program, Creating Generational Freedom, is to help physicians do just this. And so you have access to our vetted agents. They speed the process up for you. You can have done for you services where the software setup, all of that is done by our physician coaches. And so if you aren't on the wait list, or you're considering doing this, go to generationalwealthmd.com/waitlist in lowercase. You can book a call with a team member, or you can get on the wait list. But it's a done-for-you service helping you buy profitable properties. I mean, it's a no-brainer. Can you still do this? Yes, right? So that's strategy. That's if you're trying to reduce W-2 income, right? In that subcategory, you have short-term rentals. That's number 1. What is the second one? Medical office buildings, right? And so if you have a practice and you buy your own medical office building, and in the year of acquisition, you group your medical office building with your practice, and right, that's an election that your CPA will do for you. We have had students who do this every year, and some of them, so Sumana, who's one of our one-on-one clients, she used the strategy to shelter $800,000 of clinical income from taxes in 1 year. right? And so super powerful. You need to use the grouping election. So make sure you talk to your CPA about this. Do you still have time to do this before the end of the year? Yes. Yes. Right. So that's subsec category number 2 if you're trying to reduce W2 income. What's number 3? Many of you probably heard about this. It's oil and gas, right? So what can you do to reduce your W2 income? Another strategy is investing in oil and gas. Now, I want to be clear about this, right? Whenever we talk about investments, we always say, what is my return looking like? So you need to compare, return profiles. And the second thing is going to be, what is my risk profile looking like, right? So always looking at 2 things. So when you're talking oil and gas, we don't have too much time to deep dive into this, but we haven't, guys, if you're on YouTube or you're on the podcast, we have other episodes where we talk about oil and gas investing, so go listen to it. But the big takeaway, right, the big picture view is you have 2 ways of investing in oil and gas. One is mineral rights, which doesn't give you tax losses. The other is active drilling, right? When you do that, you have cost of equipment that transfers over to investors as depreciation, and they transfer over as active losses because in year 1 you are a general partner, and those active losses can be used against your W2 income. Now, when you are a general partner, to get those active losses against your W2 income, you also take on liability, right? So you don't have limited liability like you do if you are a limited partner in, say, apartment syndications, right? So what's the risk? A, you have liability in year 1. B, you want to make sure you understand the track record of the sponsors you're working with. It is a field where it's very, very hard to understand what someone's track record is if they had a bad deal. So really try to understand what their track record has been, right? And then the third thing is with oil and gas is that your income is going to depend on production. So if there's something with a well that isn't producing, or you have wells that, we're supposed to have oil, but there really isn't much production. So it's affected by production, which again, there's no guarantee over there. And the second thing is going to be it's affected by oil prices, right? So a lot of these oil and gas deals, a break even is typically between $30 to $40 a barrel. So you need to know what that is, understand the risk as you go in, right? And so those are the things you want to understand. And there is a lot of due diligence that you need to be able to do over there, right? And so I always say, see if there are some operators who in year 2 will allow you to go from a general partner to a limited partner, right? So you're reducing the risk over there. And so what that also does is that if you look at the return profile of these investments, it's typically a 1.7 to 2.5x over a 7-year period, right? That's what they're projecting. So if you put in 100,000, you're supposed to, if things go according to projection, get anything from 170,000 to 250,000 over the course of 7 years, right? But if you are active in year 1, you get active losses, and if you continue to be a GP in your in the years moving forward, then all of that income is also active income, and again, you're paying taxes on it, and you're looking for ways to reduce taxes over there, right? And so one way is to work with operators who make you a limited partner in year 2, which means in year 2, that income now hits you as passive income. You could use syndication losses from when you invest in syndications to offset that passive income, because now you have passive losses, right? So things to think about. The other thing is understand the return profile, right? Compare that to other investments. Also make sure you're comparing the risk profile. Oil and gas inherently is more risky because of all these variables, right? On the back end, it's not like you actually have the real estate, that you can exit out of. You can, but it doesn't have as much value once production stops tapering, right? So production within in this space typically is really front loaded. The first 5 years is when you're seeing the most production, and in best case scenario, your entire initial investment is returned over a 5-year period, and then you have somewhere from 8 to 10% in terms of cash flow that's taxable on the back end, right? So just make sure you understand what that return profile looks like, if that's something that makes sense for you, what the risk profile looks like. And I would say the biggest thing you can think of, and my biggest takeaway for you, is think about asset allocation, right? When you're thinking about investing in oil and gas, think about it and say, is this an investment for me, or is this more for tax or a tax play, right? Because at the end of the day, the investment, the numbers need to make sense from both risk and return profile perspective. And I want you to think about asset allocation. So how much am I going to allocate to it? And typically you don't want more than 10% of your portfolio to be in commodities. So just be intentional about it, right? Know what that number is for you and make sure you stick to that. So no emotional investing here, right? Okay, so that is category one, first power move. How can I reduce my W-2 income? We talked about short-term rentals. We talked about oil and gas, and let me do that. Okay, perfect. We talked about short-term rentals. We talked about oil and gas. We talked about medical office buildings, right? So we talked about that. Now, power move number two. What can you do to reduce taxes on passive income and passive gains? And again, this may not apply to all of you, but I think anyone with any form of real estate or any sort of passive income coming to you from other business sources or any kind of passive gain should really strategize around minimizing taxes over there, right? And so you don't want to pay the highest tax bracket, taxes on your passive income, because you will be charged that if you don't do something about it, right? So in my world, I like to say your pigs, which are your passive income generators, should have PALs, which are passive activity losses, right? So what are passive income generators? What are pigs? This is where your short-term rental in year two, if you're not materially participating in it, it becomes a pig, right? This is where if you have rental properties, you don't have leverage in, those are passive income generators, because depreciation is not going to offset them, right? So that's going to be a pig for you. If you have a business that you're not materially participating in, there are a lot of physicians who invest in surgical centers, endoscopy centers, and that is hitting their passive income bucket on an annual basis, right? Some of them get bonuses or buyouts that are also hitting their passive income bucket. We talk to them all the time. We help them strategize around getting passive activity losses to offset that, because just because it's in the passive income bucket doesn't mean that you're getting taxed at a lower, tax bracket. It is also your marginal tax bracket. So are you strategizing around that? If you have sold real estate and that's hitting your capital gains in the passive bucket, that's a pig. What are you doing to get PALs, which are your passive activity losses? And this is where where I love, and I do this all the time, right? I love syndication losses from real estate, from investing passively in apartment complexes, right? Because if you have passive income and you're trying to get passive activity losses, then our syndication opportunities in multifamily, the most recent one is the deal we have in Houston. You're getting, for a 100K investment, you get about 40 to 50,000 in losses. Those losses can be used against your passive income, right? And so that's gwcapital.com/Houston4 in lowercase. You can go take a look there, book a call with the team if you need to. But these are ways where the last day to soft commit, guys, is October 31st. So if you're considering that, then go take a look at it, book a call with the team if you need to, learn more about the investment. You can soft commit right there. But gwcapital.com, we always have opportunities where you can find passive losses in our opportunities and use it to offset passive income or passive gains, right? So your pigs should always have PALs, and that's something to strategize around. This time of year, take a look. I always tell my friends, I go for dinner or lunch, and they're like, they have investments, and I'm like, do you know what your Schedule E was last year? Do you know how much you paid in taxes on your passive income? Was it, what on paper? Because with passive income, on paper, if you have real estate, you can have depreciation losses, right? That helps offset that. So, but you need to be intentional about knowing how much you're paying in taxes on your passive side, right? Especially if you have passive income or passive gains coming in, then you need to strategize around that. And it's amazing to have passive losses from syndications. Okay, that is power move number 2 for those of you with passive income or passive gains. Now, with any kind of real estate, just make sure you're taking a look at your Schedule E and you know what you're paying. Okay, and you're strategizing around it because you still have time, right? If you're looking for a quick win, gwcapital.com/Houston4. Otherwise, we always have opportunities that are coming up, and so strategize around that. Now, power move number 3. You can see I'm rushing through this. I feel like I could deep dive into each of these topics, but today it's going to be all high level. And I want to share with you a lot of different ideas that you can think about and mull over. And this is the perfect next 2 months to do that. Now, power move number 3, how can you earn better income? Because not all income is created the same, right? So it's not just about how can I get more income, how can I earn better income? Rental income, you know that if it's structured right with leveraged real estate, rental income is tax deferred. How? If you get cash flow from a long-term rental that you own, or from a syndication that you're invested in, because of depreciation, that income is on paper because of passive losses. The income hits your, like, so if you're in a syndication with us, the income is hitting your bank account every month, but you're not paying taxes on it because on paper you have depreciation losses, right? So rental income is tax deferred, right? And then ideally our goal is to keep deferring that as much as possible so you never have to pay those taxes, right? And there's something called step up in basis, so hopefully your heirs never have to pay those taxes again, right? And so that's important. Now, sometimes we think, hey, if I make more money, I get punished more, and that's true for W-2 dollars, but it's very different for all the other kinds of income you make. And so this is where I want to highlight something that I hear people say all the time. Hey, 5% cash flow from our real estate opportunities. Maybe I'm just better off staying in a savings account, right? Because I'm getting maybe 4% and you are, and it's going to keep dropping as interest rates drop. But here's the thing. Because I have interest income too, right? Because we hold reserves for GW Capital, and we get, like, end of the year when I'm looking at those numbers, I mean, it's painful because if I made $50,000 in interest income versus $50,000 in real estate income from my syndications, now the syndication $50,000 I'm not paying taxes on, so it's hitting me. I'm not paying taxes on it because of depreciation. But the $50,000 I get in interest income, I'm paying marginal taxes on that. So if I'm in California, I'm paying more than 50% taxes on that income. So if I got 5% in cash flow from my real estate syndications on average, and most of our deals are anywhere from 5 to 7%, I need to get 10% in interest income for that to be equal, right? And we don't see the best funny part is that you're not seeing that come off of your bank account. You're seeing that you know that's when you pay taxes, and most people don't realize that that's what's happening. Same thing with, I remember during the pandemic when people were option trading, and I was like, oh my God, my bank account has $12,000 extra, and that's my gain from trading. No, it's not. It's because on the back end, when you pay taxes, you're paying marginal taxes on your short-term gains, right? And so I had so many friends who were trading, and whenever they told me what their short-term gain was, I was like, take 50% off of that because you live in California and you're going to be paying taxes on it. And most people don't intuitively do that because they don't see it go off of that account, right? And so something I want you to be intentional about is what kind of income are you growing, right? Income is not all treated the same, and interest income is very different, or short-term gains is treated very differently from, say, real estate income, right? So be intentional about that. Like I said, rental income is tax deferred. We want you to build income that is tax-free, right? And that's because then your effective tax bracket drops, right? This is something all of us can do. If you add an additional 100K in income by taking call and by working weekends versus adding an additional 100K in income, that is rental income, that is offset by depreciation. Think about it, right? You have to make twice as much taking extra call and, oh my God, just think about it, right? Twice as much taking extra call and working weekends. That is active income that's taking your time away from your family, for it to be equal to like half the amount in rental income where it's completely passive. So be intentional about what kind of income you're increasing, right? And so again, if you're looking for an opportunity right now, a quick easy win is gwcapital.com/Houston4. That's the opportunity we have right now. But we'll always, if you go to gwcapital.com, we always have opportunities that we do a lot of very deep due diligence. You won't believe it. I was on 7 calls today just doing due diligence on the next deal we're going into, and so that's what we do. So we take that off your plate, right? And so and so if you're thinking about increasing your income, be intentional about the kind of income that you're increasing.
If you're interested in learning how to invest in long-term and short-term rentals the right way, so you can accelerate to financial independence with the support of mentorship, community, and vetted investor agents in strong markets across the country, then get on the waitlist for the next cohort of Creating Generational Freedom at www.generationalwealthmd.com. You don't have to learn from decades of costly mistakes by yourself. The program is only open for enrollment in the spring and fall each year. In the last 6 months alone, our members have acquired over $60 million of real estate, and more importantly, they're living life and practicing medicine on their terms. You don't have to do it alone.
Now, The other thing to remember, like I said, is like, yes, it's tax deferred, but ideally you're doing on the back end with real estate income, you're doing a 1031 exchange, or right now with 100% bonus depreciation, something that we call a lazy 1031, so that you're constantly like deferring having to pay the tax, and then when your heirs inherit the property, there's a step up in basis, which means no one pays all of that depreciation recapture. No one pays their capital gains, and that's what we like, right? So it's about getting smarter and earning better income. Okay, that was power move number 3. Let's move on to power move number 4, which, like I say, I don't always learn new strategies, but sometimes it's even perspectives, right? And so this is something I've used in the past, but I heard a recent tax podcast, and the way they conveyed the message, I thought was beautiful. So we're going to talk about power move number 4, which is about combining Section 179 deduction with leverage. I love it. And I always, you've heard me say this, and people say compound interest is the 8th wonder of the world. And I mean, like, nothing really matches leverage, right? Good leverage used correctly is just beautiful. So I'll show you an example of how a $100,000 investment can give you $500,000 in losses that you can use against your W-2 income if you wanted to, right? And so technically, could this have gone into category 1? Possibly, but it's a very different strategy. So we're going to talk about it separately so we don't confuse you, right? Okay, so now this is one of the most underused strategies, but it's one of the most powerful moves you can make before the end of the year. I've done this multiple times. And so I'm going to start off with the easiest one to understand because you've probably heard it before. And then what I'm going to do is I'm going to go and talk about some other examples that fall in the same category, right? Okay, so the first one is going to be using Section 179 to buy a business vehicle, right? So now if you invest in real estate, okay, and you have, especially if you have real estate professional status, right? Or you have any business, an active business, and you buy a vehicle that, and here's the interesting part, right? So this year, you have, if you take 100% of the vehicle's uses for your active business, right? And so if you qualify as a real estate professional for real estate or any other active business that you are active in, materially participating in, right? Any business that you're materially participating in, you buy a business vehicle. Suppose you buy it for 0% down, right? Buy a vehicle that's worth $100,000 and it is over 6,000 pounds. So it qualifies for Section 179 deduction. That could include certain certain Tesla Model X. There are certain BMWs, certain, I believe the Audi Q7, the X5, the GLE. There are certain models that qualify for it, right? So anything over 6, so it doesn't have to be a van, right? So that's anything that qualifies for Section 179 depreciation, and it qualifies as a business vehicle that you're using 100% in this calendar year for business use, right? And for the next 5 years, you're using it at least 50% for business use, right? That's the criteria. Then you can take 100% of that cost of the vehicle. Even if you put 0% down, the entire vehicle cost, the entire 100,000 becomes a business deduction for you, which if it is an active business, that becomes an active loss for you. Right? So how beautiful is that? So that is one of the most powerful ways you can use leverage, right? So you put less down to buy something, but you depreciate the whole thing and use 179. So you can even use a combination of Section 179 bonus depreciation as required to get those losses, right? And so that's a beautiful thing. Where else can you use this? If you have another business where suppose you have equipment, right? Like construction equipment that you are leasing out, and that's your business and you're active in the business, then if you use leverage to buy, so you use 100,000 to buy equipment worth $500,000, the entire 500,000 can be a deduction, and those are active losses, right? If you're using software in a business that you're in, right? And again, you use leverage to purchase the software, the entire software becomes a deduction. This also applies to gas stations. If you've heard this, and since we're talking a lot about real estate, and I had to mention this, right? And so I have a friend who's looking at gas stations, and there are certain criteria. The convenience store has to sell at least 50% petroleum products for it to get depreciated on an accelerated basis, but you can get a full deduction, massive deductions over there, bonus depreciation and Section 179 depreciation that allows you to depreciate the asset and get active losses. And again, you can use leverage, right? So 100K investment into something where you're using a loan to purchase equipment or software, and the entire cost of that product can become an active loss for you, right? And so you have to do this before the end of the year to qualify. And so if you've been sitting on a business idea that requires equipment and you know you're going to do it, then think about timing, right? So think about timing. So that's something I want to leave you with. Now, we talked about 4 really powerful tax moves. Some of them may not be for everyone. Honestly, earn better income. I think that applies to everyone, right? That's one of the things that really applies to everyone. But this last move, the 5th power move, is something that everyone can do and everyone must do. And because I always have so much I want to share with you, this clubs, let me see, 5 different things in here, right? So 5 different things, but these are last call levers that you can pull before December 31st. And I want you to think about it, right? I want you to think about it. And so the first one over there is going to be, now this is a little controversial. Now remember, move 1 and move 2 are opposite ends of the spectrum. And I want to get you thinking about these 2 strategies as being very distinct from each other and working for very different sets of people, right? Okay, so keep that in mind and hear me out, and then and it'll at least help you start having conversations. Okay, so first one, maximizing your retirement accounts and your HSA accounts. Now, this is something this is traditional teaching. You've heard this all the time. Right? So maximize your retirement accounts. If you have capital you want to put into a SEP IRA or a solo 401k, especially if you're an entrepreneur, think about doing it, right? Reduce your tax liability. That's something you want to think about. Now, you've heard that before. That's traditional teaching. We want you to think outside the box because traditional teaching doesn't apply to all of us, especially if you're someone, and that works really well for low-income earners because in retirement, they are possibly going to be in a lower tax bracket. Many of you are superstars who are in this weird bracket where in retirement, either because we're going to all work for, the foreseeable future. We may work differently, may look different, but you intend to keep making money, especially if you're growing your real estate portfolios. You may be in a higher tax bracket in retirement, right? And that's not something you think about intuitively, and you're not taught to think about it. But you will hear more and more conversations about Roth conversions as you get to your 50s, or as you talk with people who are in their 50s or 60s, right? You'll hear about Roth conversions. And so the subcategory 2 over here is going to be think about Roth conversions, right? Why? And what you should do, I'll tell you this super smart strategy. If you're thinking about Roth conversion, do not go do a Roth conversion until you hear this strategy, right? This is something that I learned recently, and I don't learn a lot of new strategies. And so this is a power move it's a subcategory power move, but I want to share it with you right now. So why would you think about a Roth conversion? A lot of us are going to be in a higher tax bracket in retirement. That's a good thing. But you have to plan for it, right? How do you plan for it? You plan for it by doing Roth conversions. And so you will hear sometimes your employer will say, hey, you have your traditional 401. You could also do a Roth, a retirement account. And what happens with the Roth is that you're paying taxes today at your tax bracket, converting that retirement money into a post-tax Roth, moving it into a post-tax Roth account. And then the money grows tax deferred now, right? Like, so now it grows, and suppose you have it. So instead of paying taxes on $100,000 today, when you move it into a retirement account, you're letting it grow within the retirement account. And then at some point it's worth $1 million and you're paying taxes on it then when you're withdrawing it, which makes sense if you are in a lower tax bracket in retirement. Now, if you are in a higher tax bracket in retirement, right, and you have required minimum distributions after a certain age, right, that's a bad scenario. That is shooting yourself in the foot. So if you have $100,000 today, you can pay taxes on it today, take it out, put it into a Roth, and let it grow there without having any tax implications. That's what many of us need to think about. And if you're considering a Roth conversion, I want you to hear this strategy and talk to your CPA about it. There is a way with a Roth conversion to do a Roth conversion without actually paying taxes on the entire amount. And that is when you invest through a self-directed IRA into alternative assets. If you have alternative assets in your self-directed IRA, I know many of you have Think about it. You're investing your syndications through self-directed IRAs. If you're thinking about it and you haven't done it, we have IRA custodians we can connect you to. So book a call with the team or shoot us an email at gwcapital.com. We'll connect you to our IRA custodians. But if you have a self-directed IRA, this is not a Fidelity or a Vanguard or a Charles Schwab where you can go in and pick your investments. No, a self-directed IRA is through a custodian who allows you to invest in alternative assets like real estate, right? Or commodity or cryptocurrency. So if you have a self-directed IRA and you are invested in alternative assets, the IRS allows you to devalue, so the IRS doesn't allow you to. It is legal to devalue those assets, right? And so if you have $500K that you invest into alternative assets and you're trying to move that into your Roth, you don't have to pay taxes on $500,000 because there are companies who can do this for you. When you get your custodian requires a valuation of your asset, and the value can be dropped because of illiquidity and lack of control. Suppose you invested in a syndication with us, the asset, even if you have $500K invested in it, can be reassessed at a lower value because of illiquidity and lack of control. And when you transfer that into a Roth account, then instead of paying taxes on the $500K that you invested, you'd potentially be paying taxes on the $250K that it's now valued on. So you can do a Roth conversion without really having to pay taxes on the entire conversion, right? So something that blew my mind. I want you to think about it when you're thinking about Roth conversions. And so think about it. So you may be someone who may want to max out your retirement accounts, or you may be someone who wants to think about Roth conversions, and you can be strategic about Roth conversions. So without taking up too much of our time, let's move on. This is also a time you want to think about your charitable allocations, tax-free gifting that you can do. If you have a business, you can gift a portion of the LLC to your kids, right? As long as you're within the limits, right? Donor advised funds. Many of you have been thinking about it. This is a way to get a tax break today and drop the funds into your donor advised fund. It can continue to grow over there as you elect to make charitable donations. So again, things you want to plan around before the end of the year, so you can take advantage of that. And then tax loss harvesting, guys. So again, these are smaller dollar amounts, right? So you can, if you, tax loss harvesting, and you can go Google this because I probably don't have time to explain the entire concept, right? It's a way to use up to $3,000 in tax losses, right? So if you have losses in an asset and you realize those losses this year, and if you don't have gains to offset that, you can use up to $3,000 in losses against your W-2 income. And if you have something in addition, it carries forward and you can use it in future years, right? Now, when you are tax loss harvesting, what a lot of people do is they will, if they have an asset that has depreciated or lost value, you can sell that, realize the losses, use that against your W-2 income, right, up to $3,000, but then they will go buy something similar, a similar asset that can now increase in value, right? So you realize the loss, but you're reinvested, right? And that's the thing. Now, you want to be intentional about a wash sale because the IRS says that within 30 days, if you buy the same asset back, then it's considered a wash. So you can't go buy the same thing, but there are workarounds. But you want to be intentional and just make sure you aren't triggering a wash sale. Tax loss harvesting, I don't want to go into too much detail. That's something to think about end of the year. And then if you have a business or you have real estate, I always say make sure you're maximizing your deductions. If your kids have been helping you, hopefully you've been paying them. That's what we call income shifting, right? Paying your kids, getting them to invest into their Roth, right? When they're in this really low, they basically pay zero in taxes and they can invest into their Roth. So you're taking it off of your high income tax bracket. So think about paying your kids, think about maximizing your deductions. If you're traveling to a property, if you have a short-term rental and you're traveling to a property, that becomes a business deduction. There's actually a blog post on generationalwealthmd.com about how you can maximize deductions if you're a business owner or a real estate investor. Take a look at it. But these are like final 60-day cleanup moves that I think everyone should know about and everyone can implement. That's in addition to power move number 3, which was earn better income. All of us can do that, right? So 3 and 5 works for everyone. Everything else, I hope you're someone who really takes action and you use power moves 1, 2, and 4. But I know it's like not just 5 strategies, right? I try to club 5 things into each category. I'm hoping these just give you ideas for conversations to have with your CPA. This is a great time. And if you haven't, make sure you are that you are signing a contract with your CPA. The really real estate savvy CPAs usually get booked up pretty fast. And so if you're looking for a CPA, if you fill out a form at generationalwealthmd.com/CPA in lowercase, we can connect you to our real estate savvy CPAs, and then just make sure you're engaging them as soon as possible if you require someone. And they can also help you with planning, right? So those are the 5 power moves. Now, don't leave yet. If 2026 planning is something that you haven't done, then this is a good time to think about it, right? If you're someone who's been thinking about real estate professional status, we've had so many students do this. We've had stay-at-home physician parents who have focused on real estate, right? And that's something you need to plan for 2026. This is when you start planning it. If you qualify as a real estate professional, which does not require you to have a license technically, but it requires you to spend at least 15 hours a week on average, so 750 hours over the calendar year in real estate. We've had students who've sheltered up to $500,000 of their spouse's income from taxes just using this, right? And so this is a super powerful strategy, especially if you are, you know that you want to build your legacy wealth using real estate, right? And if you're planning for real estate professional status for next year, your prep starts now, not next summer. So I want you to go to generationalwealthmd.com/waitlist in lowercase and get on the waitlist or book a call with the team. You start planning, and I say our current fall cohort just started. This is a great time for you to get in, start learning, educating yourself, so you're preparing yourself. So do that, right? So if I were to leave you with like 3 different paths, this is it, right? If you want to shelter your W-2 income from taxes this year, then get on the waitlist and book a call with the team. That's generationalwealthmd.com/waitlist, right? You can still do it before the end of the year. Like I said, sometimes all it takes is 10 days for someone to get in. You have about 21 days to still take action and get a short-term rental if you've been thinking about it. Do it. Just do it. Just get on a call, book a call with someone. That's at generationalwealthmd.com/waitlist in lowercase. If you are trying to earn better income, and if you are trying to get passive losses, then go to gwcapital.com and book a call with the team, right? Book a call with the team. gwcapital.com/Houston4 is our current opportunity. But if you're listening to this on replay and you want to book a call with the team, it's just gwcapital.com. This is where we have vetted opportunities. We'll go over what your goals are, what strategy makes sense for you, help you build your buy box in the passive income world, right? And start earning better income, start getting those passive losses, and really starting to become tax efficient. And if you're someone who's thinking, hey, I want to really qualify for real estate professional next year, I want to help my, it's either you, and you can do this. I did this, right? The year I got reps, I transitioned from full-time to 1 day a week in June. And so that I qualified for reps in that year. This could be you if you're doing this yourself. This could be you and your spouse. If you're planning this, this is the time you start planning. This is the time you start educating yourself. So go to generationalwealthmd.com/waitlist in lowercase and book a call with the team. Let's hop on a call and talk about what makes sense for you. I'm hoping this gave you enough things to think about, right? To know that it's not the end of the year yet, right? So don't make that excuse. You still have any of these power moves can be executed right now, right? So you still have all these power moves to use. And so you still have time, and there's so much you can do to reduce your taxes. And I want you to really start becoming tax efficient. I hope you love it. Share in the comments what you loved most, what tax strategy spoke to you the most. And I'm here to support you guys. Awesome. Okay, I'm not seeing Q&A on here, so what I'm going to do is I'm going to quickly go on to my phone to see if there are questions in there, but I want to pause for a little bit. Usually with with questions, with tax questions, there are usually lots of questions, so I want to make sure I'm supporting all of you. So let me just take a look and see if you have questions. Hey, Anne. Okay, so I'm going to take a look at those questions. But what I also want you guys to know is that if you're listening to this on replay, keep dropping your questions in the comments, chats, YouTube, on Facebook, and I will get to them on the back end, guys. So Anne says, can you do both? Can you max out your 401 and still do a Roth conversion? yes, you can. And so you can do a Roth conversion, right? Because a Roth conversion essentially is taking money from your IRA and moving that into a Roth account. Now talk to your custodians, to your retirement plan providers to see. You can do both. I believe you need to have money in an IRA, which is either from a previous employer, right, where you can do a Roth conversion. Again, I'm not 100% sure, so I want you to make sure you're getting the best advice. Now, some of us can contribute to a 401 plan and to a Roth at the same time, right? That's employer specific. But a Roth conversion is essentially taking traditional IRA funds, which are typically from a previous employer, and moving that into your Roth account, right? So those are two different things, and it doesn't really. Is there a limit to Roth conversions? Like, they've opened up your ability to do massive Roth conversions, especially with this administration. So there is a lot of room over there in terms of what you can do. So yes, you can do both. Just talk to your custodians and make sure that you're doing this in the most efficient way. Because if you have an IRA and you're trying to do a Roth conversion, you want to be intentional about what's in your IRA, because that can trigger the pro rata rule. So you want to make sure you're doing it correctly. That's all. Okay, guys, awesome. I'm going to be monitoring the chat. If you have more questions that come up, please drop it in there. And just let me know what your favorite strategy was. I always find that interesting. The problem with Facebook is the algorithm is just not what it used to be. And so just if you don't see me respond, just tag me on there and I will come in there and drop a response. But thank you, everyone, for staying with me for so long on a Thursday. I hope this was helpful. And I will see everyone next week. Take care, guys.